Kevin Hincks and Renita Young joining me this morning. Our team here to assess the action and the news flow. There's a decent amount of news, Kev, but it still doesn't seem like any top tier, get the breaking news now. It just kind of seems like we are drifting faster to the downside without a lot of support or two-way trade.
Good morning, Oliver. Well, the news flow that we've been covering really since the open Monday morning, Oliver, the news coming out of China is not good, not favorable. More news this morning about Chapter 15 bankruptcies and more stimulus coming from the Chinese government. So China's certainly going through a different scenario than the U.S. is right now, Oliver. But what's changing today? What's the difference between the other 4 days this week and today? Well, we've got yields lower this morning, sharply lower, as 30-year bonds, 10-year notes, they're all rallying this morning, Oliver. That's the different tone that we have. Remember, I'm a big proponent of how we end the day, how we end the week. So I think today's trading day leading into NVIDIA and Jackson Hole next week, how we end this week is going to be pretty important, Oliver. So the one difference that we have a relatively neutral U.S. dollar, down slightly, but we've got lower yields. We've got the 10-year now down to 4.26 to start the day. So that could be some type of relief from the pressure on these markets. Do I know that for sure? No, I don't. We'll see what the overall tone is with these China issues. And you've got Deere & Company's earnings that were actually pretty blockbuster, but yet that stock is still lower to start the day. Let's see how that trades out. But Oliver, it's going to be a long day today, but how we finish the day going into next week is going to be vital, Oliver.
Well, I agree with you because we already know that good economic data and good economic surprises, which have led to the breakout in yields, have been bad for stocks. The question, though, is will bad economic information from a superpower like China, an admission that they need to step things up there, is that going to somehow be a good thing, right? I mean, it kind of seems like we might be one of those scenarios where it's sort of good is bad and bad is not good either, right? I mean, because to your point, can't blame this morning on rates, can't blame this morning necessarily on the dollar because it's come off a little bit, but it still is not encouraging to see that there's a lot of slowness in China and a knock-on effect. So this market just can't really find a bull case, it seems like.
Well, Oliver, China markets are lower, which lead to lower European markets, which lead to our futures overnight. The rubber meets the road when our markets open for the day. That's when the real trading begins. I understand, I acknowledge what the futures do overnight, and they set the tone based off foreign markets. But our market will decide, all the news that we're consuming and digesting, it all goes into what yields are doing, what the U.S. dollar's doing, what crude oil's doing. That's what our stocks will pivot off of, Oliver. So I'm waiting to pass judgment on, is this going to be a down day, or how are we going to react differently to lower yields and bad China news? That's how this day will play out. And I give credence to the foreign markets, but the U.S. markets drive the others.
For sure. Okay, so it's an important little test here to see how we handle rates down on Chinese weakness. That's a good point. It's a bit of a different kind of order of events, the way things are playing out this morning, as opposed to rates blowing out, causing stocks to drop. Let's talk about some of those China stories in specific, including XPeng numbers, which are hitting that stock, and that does kind of signal a bit of a sentiment shift, Renita, because that company had done very well here the last several months.
It had, and it's a completely different story today. Now, although deliveries spiked higher in this past quarter, the company reported a wider than expected loss, and revenues did not meet expectations. So if we take a look at the numbers, we can see that the adjusted loss swelled to 43 cents a share. And revenue came in below expectations at $698.19 million. That was almost a 32% contraction from the second quarter of 2022. Margins contracted, expenses went down, Vehicle deliveries, they did come in at a different point there at 23,205, which actually vehicle deliveries dropped this quarter. Pardon me. They did not surge, they dropped this quarter. Total stores, however, grew to 411. That was a substantial increase from the second quarter of 2022. And charging stations also grew by a pretty large measure as well to over 1,000. Now, something to look out for on this company, the partnership that it announced back in June with Volkswagen. They're producing Volkswagen branded EVs using key XPeng technology and platforms. And then looking forward, this third quarter deliveries are seen at 41,000 at the high end. That was the better than expected gain than analysts thought. They were looking for 40,000. And they're also forecasting a revenue of 1.23 billion at the high end. That would be a gain of about 32% at the high end. So you can see that the expectations are high for XPeng, but this is not a great report at all.
Yeah. All right, not perfect by several definitions here, to your point, but also not the worst. I mean, still, compared to a quarter ago, a pretty decent jump in the deliveries. Maybe not the same pace from a year ago as we saw there for the figures. They're moving in the right direction, but the market now taking a very different approach in how to deal with these numbers. So it does seem like the sentiment around these companies and these high growth businesses has changed when the backdrop is one about economic concern as it is this morning. We'll see if that has any knock-on effect in Tesla right now, but with markets down, we just kind of expect those growth companies to be heard. And appreciate it, guys. Thanks, Renita Young and Kevin Hincks.